Picture this. The global crypto market has just evaporated over $1 trillion in value within the span of 6 short weeks. A staggering blow fueled by widespread anxiety about a looming tech bubble and diminishing hopes for an upcoming interest rate reduction from the U.S. Federal Reserve. But here's where it gets controversial. Are these fears justified, or are we witnessing an overreaction that could mask even bigger opportunities? Let's dive into the details and unpack what's really going on, so even newcomers to the world of finance can grasp the implications. According to data from CoinGecko, which monitors over 18,500 different cryptocurrencies, the total market value has plunged by a full quarter from its peak in early October. For context, that means if the crypto market was once a booming party, it's now feeling the hangover of a massive downturn. Bitcoin, the heavyweight champion of digital currencies, hasn't escaped unscathed either. It's tumbled 27% during this period, landing at around $91,212, marking its lowest point since April. To put that in perspective for beginners, Bitcoin's price dips like this often reflect broader economic signals, such as investor confidence and global market trends, rather than just isolated events. The unease isn't confined to crypto. It's spreading like wildfire across the financial world, with investors bracing for what some are calling an artificial intelligence, AI, bubble in traditional stock markets. Even Sundar Pichai, the CEO of Google's parent company, Alphabet, has sounded the alarm, warning in a BBC interview that no company will be spared if this bubble pops. And this is the part most people miss. Pichai described the current AI hype as harboring irrationality, suggesting that the frenzy might not be grounded in sustainable realities. It's a stark reminder that while AI innovations promise incredible advancements, like smarter automation and data processing, the rapid escalation in investments could lead to a painful correction if expectations aren't met. This sentiment is echoed in the broader stock indices, which are also taking a hit. On Tuesday, the UK's FTSE 100, a key barometer for major companies, slipped 1.2%, extending its losing streak to 4 consecutive days. Across Europe, the Stoxx Europe 600, tracking the continent's largest firms, mirrored that decline with a 1.2% drop. The ripple effects were even sharper in Asia, where Japan's Nikkei 225 index shed 3.2%, and Hong Kong's Hang Seng fell by 1.7%. These movements highlight how interconnected global markets are. A shiver in one region can quickly turn into a quake elsewhere. Adding fuel to the fire, Sebastian Siemiatkowski, the CEO of payment platform Klarna, expressed deep concerns in a Financial Times interview about the enormous sums flooding into AI-related computing infrastructure. He pointed out that while companies like OpenAI might thrive, the sheer scale of investments in data centers is nervous-making. To explain this simply, think of data centers as the massive warehouses powering AI. They're expensive to build and maintain, and if the demand for AI services doesn't pan out, all that capital could go to waste. Siemiatkowski also flagged the skyrocketing valuations of AI players, such as chipmaker Nvidia, which became the first company to reach a $4 trillion market cap this year, followed closely by tech giants Apple and Microsoft. He argued that this automatic allocation of wealth through index funds, those diversified investment baskets many of us use for retirement savings, pours money into these trends without critical evaluation. And here's a controversial twist. Siemiatkowski suggested we might shrug off individual billionaires losing fortunes on overvalued AI stocks, but the real issue is how our pensions and everyday investments are tied to these bets. Is it fair to question whether these valuations are artificially inflated, potentially setting up millions for financial disappointment? Or are we underestimating the transformative power of AI? This debate rages on, with a Bank of America survey revealing that 45% of polled fund managers view the AI bubble as the primary tail risk. That's finance jargon for a rare but devastating event that could wipe out significant value, much like a black swan in a pond. Meanwhile, gold, often seen as a safe haven asset during turbulent times, meaning investors flock to it when other markets feel risky, is also experiencing a decline. Its spot price dipped 0.3% to $4,033.29 per ounce on Tuesday morning, hitting a weekly low. Why? Partly because expectations of a Federal Reserve rate cut in the coming month are fading. For those new to this, higher interest rates make gold less attractive since it doesn't generate income like bonds or savings accounts do. It's essentially a store of value that shines when rates are low and uncertainty is high. However, Giovanni Stanovo, an analyst at Swiss bank UBS, predicts a rebound. He believes gold will soon bottom out and recover, driven by anticipated rate reductions in the quarters ahead and continued interest from central banks diversifying into gold holdings. It's a classic example of how commodities can zigzag based on monetary policy shifts. In wrapping this up, the crypto crash amid tech and AI bubble fears underscores a larger question about market exuberance versus economic fundamentals. Do you think these warnings from industry leaders like Pichai and Siemiatkowski are spot on? Or are they dampening enthusiasm for genuinely groundbreaking technologies? And what about the potential fallout on everyday investors? Is this a wake-up call, or just another cycle in the volatile world of finance? We'd love to hear your thoughts in the comments. Agree, disagree, or share your own take on whether we're in the midst of a bubble or on the cusp of innovation's next wave.